Okay, low-key, what is the difference between cash accounting and accrual accounting? Like paying for your designer shoes with cold hard cash. While cash accounting, you're living in the moment, recording transactions only when the cash actually changes hands. It's the financial equivalent of living in the here and now, keeping things simple and straightforward. Cash accounting is all about instant gratification, seeing the money in your hand and feeling the thrill of the purchase. It's like a shopping spree with your besties. Fun, fast, and fabulous. Cash accounting is just clear and straightforward. It only records transaction when the money changes hands, making it easier for small businesses to understand and implement. Now, there's definitely like pros on the liquidity management. It provides a clear picture of actual cash flow, helping businesses manage their liquidity more effectively by tracking cash that they have on hand. Cash accounting has some tax benefits. Small businesses often benefit from tax advantages with cash accounting, the only reporting income when it's received and potentially deferring tax liabilities. Accurate short-term financial position. Since cash accounting records transactions as they occur, it provides an accurate snapshot of a business's short-term financial position. Now, babes, don't get me wrong. While the pros of cash accounting are hot, they do have some cons. Cash accounting has limited insight. Cash accounting might not provide an accurate long-term financial picture since it doesn't account for all accounts receivables, accounts payable, or accruals. This can lead to misleading financial statements. There's difficulty in tracking performance. It may be challenging to track performance accurately since revenue and expenses are recorded when cash is exchanged, not when the transaction actually occurs. This can distort the financial performance of a business, especially if there are delays in payments or expenses. There are tax disadvantages. While cash accounting can offer tax benefits in certain situations, it can also result in higher taxes during profitable periods, as income is recognized the year received regardless of when it was earned. Less attractive to investors. Investors and lenders may actually prefer accrual-based accounting since it provides more accurate representation of a company's financial health and performance over time. Cash accounting may make a business appear less stable and profitable than it actually is. On the other hand, accrual accounting is like playing for the long game. You record transactions when they're earned or incurred, regardless of when the cash actually flows. It's like investing in a timeless piece of art. You may not see the returns right away, but you know it's worth the wait. Accrual accounting is the sophistication and foresight, painting a true picture of the company's financial health over time. It's like sipping champagne at a glamorous, elegant gala. Pros of accrual accounting is it paints an accurate, long-term financial picture. Accrual accounting provides a more accurate representation of a company's long-term financial health by recording revenues and expenses when they are earned or incurred, regardless of when cash is exchanged, unlike cash accounting. This gives stakeholders a better understanding of the company's performance over time. Accrual accounting has a matching principle. Accrual accounting follows the matching principle, which means that revenues are matched with expenses incurred to generate them. This provides a more realistic view of the profitability by showing the true cost associated with generating revenue. There's better decision making within accrual accounting. Accrual accounting provides more comprehensive financial statements, including balance sheets and income statements, which can help a business make better informed decisions about investments, expansion, and financial planning. And then also accrual accounting complies with GAAP. Generally accepted accounting principles, GAAP, often requires businesses to use accrual accounting and financial reporting, especially for publicly traded companies. Adhering to GAAP can enhance the credibility with investors, creditors, and regulators, and that's super hot. On the flip side, the cons is that accrual accounting, it's complex. Accrual accounting can be more complex and time-consuming to implement compared to other cash accountings. It requires tracking accounts receivable, accounts payable, and accruals, which may require additional accounting expertise or software. There's potential for manipulation. Because accrual accounting involves estimates and judgments, there is a risk of manipulating or misinterpreting financial statements, especially if management is not ethical or competent. So don't be incompetent. Delayed recognition of cash flow. Accrual accounting may not accurately reflect a company's current cash position, since revenues and expenses are recorded when earned or incurred, not necessarily when cash is received or paid out. This can make it harder to manage short-term cash flow. Tax complexity. Accrual accounting can complicate tax reporting, especially for businesses with complex revenue recognition or expense matching requirements. It requires additional calculations or adjustments to reconcile taxable income with the financial income statement. How do you choose between the two? It's so hard. Well, the thing is that you need to do what works best for your company. Now, while cash accounting is super hot, it's simple, straightforward, and it can be done by one person pretty easily. Accrual accounting is really accurate. You need to figure out what your company's needs are and how you can best satisfy them with the accounting method that you have in store. So slay. Basically, just choose your hot financial style and wear it up, baby. If you guys have any like questions, leave them in the comments below. If you want a more in-depth video, let me know in the comments below too. Bye!